This video is a warning to all of those people that just going out there and buying the dip. What's going on? Why the dip buying doesn't work anymore? First, we had an unbelievable bull run. Some growth stocks like Tesla grew 1000%. Bitcoin, crazy. Teladoc, Peloton, Zoom, all of these crazy stocks went absolutely nuts. What is now the most important warning, guys, is to watch something that is called the inverse yield curve. This video is a warning to all of those people that just going out there and buying the dip. These times are over. It started at around November, okay? November, if you are looking into one of those smaller indexes, which is called Russell 2000. Russell 2000 has, as the name says, 2000 small cap companies, okay? And if you're looking into the last couple of weeks, you see that starting exactly around 7th of November, we had the all-time high here at the Russell 2000, okay? Since then, the Russell 2000 went way down, okay? With this Russell 2000 also was selling off a very high speculative tech asset, which has a very long-term vision, but is highly speculative. This is, together with the Russell 2000, this is the first things that are selling off, okay? And let's have a look what happened in November with Bitcoin exactly, okay? Let's have a look. So November, what's that? Also 8th of November, we had the all-time high for Bitcoin. Okay, since then we lost about 45%. Okay, then it started with tech stocks. Okay, tech stocks that have like a long-term outlook, a high PE ratio, and stocks like, for example, Tesla. While Tesla is still like a cult company, and many are buying, the cult of Tesla, right? Being with Elon Musk at the forefront against the big car companies. But companies like, for example, let's take Zoom, for example. Okay, Zoom basically had also the recent high. Here you can see it sold off since August already, but here it had also like the November peak, and then it went down, right? Then we had also a very high PE, and this was like the turning point for then the other high growth stocks. Netflix, right? Netflix had just this recent, with the beginning of the earnings season, the recent, let's say, high, and then it just dropped 25%, right? And this was just in the January, start of the January, okay? This was the earnings season. Latest then, you should sniff something, okay? You should sniff that there is something wrong into the market. And why I'm telling you all that? I wanted to start to show you guys how you see these rotations into the market. When Federal Reserve said that they will raise rates, money gets more expensive because they have to fight the inflation. They did one mistake, that inflation was overwhelmingly big because they thought, we will print all the money, right? And everything will be good because there's the health crisis and we need to help the monetary system. What they did was they flashed the market with so much money. They bought bonds and they, did the QE and, just like crazy. But this is necessary, okay? Nothing wrong there. However, what came at the same time was a supply chain problem. Deliveries of semiconductor chips were broken. Supply chain issues because like wood, right, got crazy expensive. Asian countries couldn't deliver so much because they were hardly hit by the health crisis with these different variants and so on. And this was unexpected. And that's why the Fed ran from two sides, and that gave us a crazy big inflation. So slowly they need to go back. Now, however, they should have done it a little bit earlier. Now the market is uncertain. And with the last Fed meeting, even gets more uncertain because the Fed is still, juggling around and not saying really what they will do. And they actually said something, and here's a small clip that I posted on Instagram. It's just 15 seconds, so bear with me, that Federal Reserve thinks still the asset prices are somehow inflated. Here we go.
And there are four key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say.
So as you can see, everything shows you that the machine is running, okay? And that's why we have like this movement into the markets, out of growth into value, out of shitcoins, out of Bitcoin, out of tech stocks, Tesla down. And everybody is just thinking, what's going on, right? What's going on? Like why the dip buying doesn't work anymore? Well, if the rates are hiking, first, we had an unbelievable bull run. I mean, this was a crazy bull run. From the lows of March 20, and let me pull up the chart because this is just, let us visualize that for you. We had like already inflated valuations right here before Rona hit. Then Rona hit and we hit the 2,300 in the S&P 500. From there, with the beautiful help of the Fed, we gained 108%. Okay, this is just the index. Some growth stocks like Tesla grow 1,000%. Bitcoin, crazy. Teladoc, Peloton, Zoom, all of these crazy stocks went absolutely nuts. Now, the recent correction is just 8 to 10%. So what I'm saying is, it's just a small correction. Everybody getting already crazy. Now, it can get much worse. There's just like, it's called the capitalization, where, crazy amounts of people are just selling because they think this is the end, okay? They think this will drop. Now, with this thinking, this didn't happen yet, okay? What you saw Monday is just like a small appetite what can happen. The S&P 500 went 4% down and recovered. This was like a boo, and then was like, I'm just joking. But this can happen for real, and the S&P can in multiple days lose like 5, 7, 2, 3, 4%, and then a little bit bounce back, and then again, so this can happen. What is now the most important warning, guys, is to watch something that is called the inverse yield curve. You have the 2-year bonds and the 10-year bonds. Okay, and the 10-year bonds, you basically give money to the US government, and you get for that, currently around 1.8% every year. Okay, it's quite nice because it's basically risk-free, because when the government of US, they never defaulted, so it's pretty safe, right? However, if the market thinks, and that's, they have already like a 10-year maturity, okay? You can still trade them every single day, but you can hold them 10 years if you want, okay? What happens here is that you are giving the government money and they can do something with it, okay? Now, what happens here is those bonds getting auctioned every now and then you have prices, okay? The yields are going up and down. If many people want to have the bonds, obviously the yield that US have to pay for those investors is lower, right? Because if more people want, then we give like lower interest on the money that they gave us. If the people don't want to have those bonds, then they have to increase, or the yield increases. And with the 10-year bond, it's like a vision into the next 10 years. Okay, how the next 10 years will they be good? Then I'm buying them, right? Because I'm thinking, okay, that's fine. So the yield goes down. But if they think, wow, what happened in 10 years? I don't know, it's not safe. Let's see what the near term shows us. The people are undecisive. So the yield goes down. When the yield goes down and the 2-year bonds goes up, you see like the 10 years and the 2 years, they are crossing each other. This was 7 out of 8 times, or 7 out of 8 last times, always prediction for a recession. And I will show you, we came very close to that in the last February. So we had an amazing bull run until about mid of February. Then we had like a correction until March, okay, of about 2.3%. Now in the S&P it doesn't justify that, but let me show you the growth stocks, okay? Let me show you, for example, Tesla. Tesla went from about almost 900, which was the all-time high by then, to losing about 30% in just a matter of 2 months. Okay, and now let me show you something else. Here you can see the inverted or the spread between the 10 years and 2 years bonds. Now, if you're looking into the last 3 years, so we had an inverted yield curve in August 2019. Okay, but then the Rona happened and so on. But look at that. In February, we had a very, very close call, okay? I think this is much better. Okay, so here you can see that, over the last year, the spread was pretty big. Until now, it's getting very, very low. So this is the crazy kind of, let's say, issues that we can get here when the spread goes smaller and smaller, right? So this is what is really dangerous for the market. And now we have, and I posted this on my Twitter account, you can follow me on Real Wolf of Dubai. We are now in the market death spiral. Higher 10-year yield, bad for tech. SPY down. But if the 10-year goes lower, inverted yield curve, and then we have the recession. You heard it here first. Share and educate yourself. It will make you rich. Because don't forget, even when this video can be maybe a little bit bearish, and guys, the market can go up for 2 weeks, maybe next week already, okay? Or go to, not to all-time highs, but to higher levels let's say over the next couple of weeks. But then we should really see the capitalization that I was talking about. Flooding out of capital of the market. This will be quite interesting. So now you know, if you heard the inverted yield curve. If you have any questions, let me know in the comments. Join our Discord if you want, with the links below. And enjoy the ride, because it's always fun and lots of education.